Hello and welcome to BQ Prime. You're watching IPO Adda, and my company in focus today is Avalon Technologies. It's an electronic manufacturing services provider to companies in India and in global markets. The company is coming out with an IPO with a price band of 415 to 436, a fresh issue of 320 odd crores and OFS of 545 crores, where promoters and some other shareholders are selling their stake. Company is valued at around 2,846 crores at the upper end of the price band. And joining me is Mr. Kunhamed Bicha, who is a chairman and managing director, and Mr. R.M. Subramanian, who is the chief financial officer at the company. Mr. Bicha, to begin with, you're raising 320 odd crores. What is the object of the issue?
So primarily, we want Avalon is seeing a large growth in our potential into the future. We want to make sure we are well funded, and most of this money is going into working capital requirements and debt reduction to make sure that the company is ready to meet the future demands of customers, what we are seeing today.
Mr. Subramanian, you had a net debt of roughly around 304 crores at the end of November.
Yeah.
So, how much of that will come down, and can you give us an idea of how the working capital cycle works in your industry or in your company?
Yeah. So Avalon Technology, as you know, is a company, electronic manufacturing service company focused on manufacturing for the world with India as a manufacturing base. In terms of the debt, we have about 300 crores in terms of net debt. Okay. And out of which 230 crores is short-term working capital, and the balance is long-term debt. Okay. And as per the objects of the offer, we will be repaying the debts of Avalon Technology, the holding company, and one of the subsidiaries, Avalon Technology Services. So about 50 to 60% of the debt will come down, and the balance will be used for working capital and general corporate purposes.
How does the working capital cycle work for you in your company?
Yeah. Our business is a working capital intensive business. Inventory is generally about 90 to 120 days in terms of average steady state inventory, and receivables and payables about 75 days each. So that is the normal steady state inventory what we work through. Okay. And that's what we've been working towards. Currently, there's been a little bit of elevated inventory, but we hope as we move along, it will come down to the steady state.
Can you just give us, sorry.
You can add a point there. Today, the current situation is because of supply chain challenges, we are carrying a little bit more than usual. But if you go back 3 years back, we were at that state. And we believe that that should come back to normalcy pretty soon.
I was looking at your RHP, and your inventory positions were higher by, say, 71% in FY22 and 31 odd percent in so far in 8 months of FY23. By when do you see normalization of supply chain happening? Because yours is a very dependent on chips and semiconductor kind of sector. So what is your strategy there, and what kind of long-term agreement that you have with your suppliers?
So for us, of course, if you go back 12 months back, the supply chain challenges were extreme. We had, very long lead times. So our customers and us both work together to make the component shortage, supply chain issues work with it. But today, what we're seeing is the light at the end of the tunnel, where we are seeing easing of this. With the easing, we come back to a normal steady state production methodology, which is much shorter cycles to get production out. But till the point the IC situation is completely done, we will be facing these challenges. But I think in the future, in the few quarters, we should be able to bring it down to our old state.
I was going through your suppliers' imports, basically. Roughly 66% of imports come from 3 countries: Singapore, China, and US. I'm assuming that you're using the Singapore Treaty. That's why a large chunk of that is coming from Singapore. But is there a plan to move some of those supply chain to India? Because the world is now looking at China +1 and other Asia +1. And there is a lot of opportunities coming up in India, where a lot of manufacturers are setting up their shops as far as chips and semiconductors are concerned.
So just to give you a feel, Avalon not only makes printed circuit boards, which is where we use these integrated circuits to go on. We also do our own sheet metal We also do our own cable assembly. Different factories do that. Our own plastics, our own transformers. All that supply chain is indigenized. So if you look at a product, a certain percentage, 30–40% of a product will be in this. This is where we think our vertical integration plays into indigenizing the components. Okay, and on the integrated circuit side, which is the other side or other half, it is a global supply chain. You see, it's US companies who own it. They may make it in Taiwan, they make it in Korea. So wherever you make it, whether it's China, whether it is India, whether it's Mexico, whether it is the US, the supply chain is always going to be global. Okay, so you can never say that it's a certain country which can, but India, my belief is if we get into the semiconductor industry into the future, there's an absolute choice. We need to make the first few steps to get a fab going in India. That's been our dream for years, because if you look at Avalon, we started with the dream of manufacturing in India in 96, 97, before the world thought India was possible. Everybody was going to China. For us, the strength was, Bhaskar, when you started the company, we had a vision of doing manufacturing in India. And believe it, after 20 years, we are seeing the excitement today, where a lot of the global majors are looking at India as the future for production. There's, of course, there's competition. But again, with the China+1 strategy, everybody's talking about it. Today, we've been doing this for 5 or 10 years. A lot of products have moved from China to us in this time. It is just not during the last 2–3 years. We're seeing inflection point. We're seeing a lot of it happen, not as much. And a lot of the new products are not going to China. They're coming more into whether it's some part of it is going to US for US, where we also have a production facility, coming to India, going to countries like Vietnam and Mexico. But I think India stands a big chance of, if we do it right, not only for Avalon, for the whole industry, to make it the next bringing up manufacturing in India. And the government is supporting that.
Give me a sense of inventory cost and material margins, because your material margins have been increasing last couple of years. Do you have enough agreements in place with your vendor or your clients, so that this higher cost can be passed through to them, especially in last 2 years when we have seen a lot of increase in chip costs, supply chain costs have gone up, container costs have gone up. Are you able to pass through these kind of costs, because more than nearly 48% of your business comes from US, right?
Yeah, maybe I'll take it up this one. We've been operating on a material margin about 34–37% in terms of material margin, and as you rightly said, it's been growing. This has been growing in spite of the chip cost going up, container costs going up. Okay, so the one thing is, in terms of our business model, is it's a contract manufacturing business, but our customers are long-term customers, and we work with them, and the customer wants to make sure that we make adequate profit. So to that extent, our cost is transparent to the customer, and wherever the cost does go up, we go back to the customers and ask for purchase price variance, or PPV, as we call in industry parlance. And most of the time, customers do accommodate that, and that is how we've been able to maintain the margins. This is to ensure it's a fully partnership model. Unlike some of the industries which are highly competitive, we are in B2B space where customers work with us to make sure that they make profit and we also make profit. It's a win-win situation for both, and that's what we are seeing on the numbers.
So if I can add one more point.
Yeah.
See, we are not into the consumer device type.
My next question was on that itself, Mr. Bicha, because okay, you're comparing yourself with the Dixons and Ambers of the world.
You're not.
They are into consumer electronics, and you're into enterprise electronics. If I can use that word.
Absolutely.
So how does these two businesses work, right? And you're seeking the same kind of valuations those companies are seeking.
So we are into the B2B. Okay, our margins are higher. A normal lifetime of a product is 5 to 15 years. There's enough. So we operate in a model where products come. 80% of our revenue comes from customers who've been with us 8 years, world majors. So they come and stick. So the more you add, you're going to have a longevity. Things don't go out of style in 6 months or a year. So we are into mission critical. So if you look at railway signaling, right? We are doing railway signaling products for the Indian market for a Japanese customer.
This is a kiosk in India you're talking about.
Absolutely, you're well aware of it. we are doing a lot of parts for planes for global majors. Unfortunately, I can't use the name different, but it's
Collins Aerospace.
Absolutely. So we do multiple parts. We are in the engine in aftermarket in the US inside planes. So it's just not, it is the capability of Indian manufacturing what Avalon shows. It's just not, I can make phones, or I can make washing machines. It's core technologies we penetrate, and these products last for a long time. On the valuations, that is a BRLM story, how the market is today. I think we're still,
As
reasonable.
promoters, you don't have any role in asking for valuations?
We do, but market conditions today, we got to deal with them. And we've got to. So it's not, it's a long-term journey for us. This is just the beginning. Okay. So it's not, we've been in this for 22 years.
My question is that, you have a margin profile of around 11.6% for FY22 and for the 8-month period, compared to consumer electronics competitors, which are much lower in single digits, which is there. But they play a volumes game, and you don't have a volumes game. It's a value game, I assume, because whether it's Collins, whether it's Kyosan or Zonar, these are high-end technologies where the volume game is not being played out, right? So how do you scale up from here?
Maybe I'll take it up this, just a couple of points. Just if you take a backseat and look at, in the B2B space, China is about 45% of the market share of the global market share. India is about 2%. Okay. And what we are seeing is global corporations are trying to move beyond China and looking at multiple geographies, nearshoring, offshoring, whatever you want to call it. Okay. If you get a 2% moving out of China, you're talking about market doubling, and there are 4 or 5 players. So the market size and potential is huge in terms of what is available, and that's what we are seeing. That's number one. Number two, coming to the margin business, just look at, we are operating about 60 to 65% throughput capacity utilization today, and the 2 on a 2-shift basis. So we have substantial capacity in terms of dry powder, what we have. And with the current order book and the robust market outlook, what we are seeing is.
Mr. Subramanian, I agree with the part of the capacity utilization of 60-65%, but the industry you are in, or the segments you are in, there many of the companies or your competitors also have the similar kind of capacity utilization, because orders don't come in bulk, right? It's prototype, and then you increase there, but it's not like 5 lakh TVs or 10 lakh mobiles, or those kind of stuff which comes in. It comes in few hundreds or thousands maximum. That's how it goes around. So how do you utilize your capacity utilization to 80-90%?
So, let me answer that. So what you say is correct. Okay, we're not in the consumer space, but again, if you are focused in the last few years and into the future, is clean energy. So today we are working a lot in the solar space, where these kind of volumes are there with decent margins. Okay, I don't want to mention margins, and these are high volume production.
So give me a sense of the segments like clean energy, mobility, industrials, and communications, and medical. Which are the segments which have the higher margin, more than 11-12% margin? Just to get an understanding of it.
Okay, so let me explain the product first. Okay, in the sense, right? So we have a cable factory, we have a metal factory, PCB factory, whatever you call it. So all of them are making their own commodities, which is the cable, metal, PCB. Only when it comes to final product box, is it called an industrial or a mobility, or that's when the segregation. So the margins are fairly reasonable across certain industries. I don't want my customers chasing me. I have a much larger profile. Okay, which you would probably know which ones they are, and they are, once it comes to us, it's there for the next 20 years. So it's getting the product into India is the challenge. And today, I think we are past that, and we are seeing multiple facilities working with us for the future.
So, what percentage of your total output, if I put it this way, where you create a fully integrated product and you sell it to the customer?
So it's around 48% as of now, and that number is growing. So whenever there's fully integration, that is where
the higher margins come in.
Margins come in, and of course, certain industries.
Okay. And between US and India, you have 12 units and 2 in US. Uh, how does margin profile work for US and India?
So let me just explain a little bit of what we do. Avalon, as such, 62% of our business is exported, is US or other countries, mostly US, and 38% is growing in India. 80% of our production is done in India. Only 20% is done in the US. What we do in the US is when customers cannot take it out of the US, US is very important for us because some of these complex products, they like to build it there first. Then they have a path to come to India. That is our success. We are the only company who has the US facility for years. Okay, where they start building there, in 6 months, they have a pathway to come to India. So that is a beachhead for us in the sense of start in the US and move to India.
So
If you
is the
want to
US
take
an
it,
integrating facility, or is it a subsystems facility?
so there are two pieces we do in the US. One is PCB assembly. Anything which is automated, you can do it in the US. Anything which is labor intensive or there's labor arbitrage, we never do in the US. We do it in India. Okay, and system assembly, like you said. So just to give you why we are excited, if I can take a couple minutes to say, there's the infrastructure bill, which President Biden has announced, that is for $390 billion for clean energy manufacturing in the US. Okay, we are in the forefront to play that. That's why we are getting with a hybrid model where the labor intensive part is done in India. Okay, the final assembly and automated part is done in the US, and we do the final integration in the US and have it called made in the US. There's a certain percentage you have to meet, but I think because of a US facility, we can participate in this. Because there's, whether it's China, India, or Mexico, nobody can participate in this. But the core of the labor-intensive part is done in India, where the labor arbitrage is coming from India, and that's why we think in the clean energy space, we are well positioned in the US market with our manufacturing in India.
You know, three specific challenges come to your industry. One is the technology changes, which happens very fast in this industry, especially in clean tech. It's it's very fast technology changes that happens. And second is standards are changing of emission standards are changing, or energy standards are changing, and that brings in a challenge at your end as well. And the third is a price erosion. As you go scale up in volumes, the erosion is much more higher as compared to your traditional rivals or peer. How do you manage these three?
So just to a very, very interesting question, very, very, I think, profound. I would like to answer it in the best way I can. So what we always feel is the core of our clean tech business is with some of the world majors. Okay, that's not going to go away. It's the Japanese customers or the US customers. I can't name them, but 70, 80% is that. But to answer your point, if you want to be in the forefront of this, you got to bet on a few well-funded companies who are changing the world. There's a hit or miss in this, but that is 20% of what we are today. I mean, we have to make those bets because those can be surprisingly large bets into the future. Because if you take hydrogen, our customers, everything is evolving everywhere. So you have to make the best bet on which is your right customer to ride on. I think we have done that, and hopefully the results will come. That will give you an exponential growth. But our core is still with the world leaders, which is still there in the clean energy.
Then how come your top two customers market share or revenue share is falling actually? Because if I look at top two customers, it's fallen from 26% odd to 18%, 26% in FY22 and 18% for 8 months. Is it a seasonality which comes into play here, or is it a genuine fall, or how, as your revenue expands, the share is falling there? And top customer also has fallen from 13% odd to 9.7%.
So what we're seeing is acquisition of new customers who are coming in a larger pie, and those will, like I said, 80% of our customers have 80% revenue from 8 customers. That is not going to be true in the future. It's going to be much better. So with these customers which you acquired, they're all kicking in. They're not kicked in, and because of the spread, it's going to go down.
Subramanian, the trade receivables is around 29% for 8 months. Is that the normal level of trade receivables for you?
Yeah, just on the trade receivables, I like to sort of clarify. Most of our customers, okay, are global majors, 5 to 10 times bigger in size in terms of what the standing is in the world over, and many of them are billion-dollar corporations. Okay, so typically our revenue, our receivables are in the 75 days range. Okay, and it's been at that. So and we have very limited problem of any receivables or bad debts. It's we are working with marquee customers, so it's been one of the good places what we've been operating in.
From a point of view of your foreign exchange exposure, is it a natural hedge for you? Because imports, what, 37-38% would be there, and you said nearly 80% is exported by
Yeah.
you guys.
Yeah,
So,
I think, yeah, you rightly said, our business is a completely dollarized business. Exports, of course, is fully in dollar. Even in domestic market, what we sell is linked to dollars, and forex variation most of the time is a pass through. That's in terms of the revenue side. And in terms of the procurement side, almost 80% is imported. So there is a natural hedge, as you rightly picked up. So the best way to look at from an investor perspective is it's a dollar company which is focused on exports, like a software company or a BPO company, and we have a natural hedge almost 80% in terms of what we do.
so are you saying that you should be looked at like a hardware, IT hardware kind of exporter instead of being electronic manufacturing services?
So I think that's what KB has always been saying. 90s we saw the wave of software in terms of doing in India and catering to the global market. And 2000 we saw the BPO wave. And what we're seeing for the industry I'm talking about is the manufacturing. Okay, so the way to look at it is whether it is electronic manufacturing or or core manufacturing. We are looking at manufacturing where we use the dollar and labor arbitrage in India and catering to the global market. That's the name of the game, and that's what we are in.
But in the electronic manufacturing or hardware manufacturing, the IPs are with the companies, and in this case, the IPs are with your clients, right? You are doing a contract manufacturing for them, basically.
So absolutely. So for example, if we have chosen that path. Okay. See, we are in a very IP protect. Our customers value the IPs. We have hundreds of millions of dollars of IP being given to us, and we have to protect it, because it's core technology. It's very easy to say I want to be an ODM, I want to be DSM, but for the comfort of the customers. For example, we make 5 or 6 different type of inverters for some of the top people in the world. Okay, we know we can make the best inverter because we have all the designs. But the day we do that, you're going to lose your 5 customers. Okay, so it is very easy to say that I can be an ODM. Yes, we can, but we don't want to be that because the core strength for us is manufacturing. We are selling a manufacturing solution. Okay, and we believe protecting the company's IPs is our foremost right, and make sure that the companies are comfortable with us. And these are Fortune 500 companies. I mean, they're looking at you for the trust to take you to the future. It's just not the cost in a lot of cases. We start businesses with a relationship. Cost and quality and delivery is given. Cost is negotiated. But for us, it's the long-term relationship that matters. Okay. So in certain industries where where we don't play, if we want to create a design model, saying all that, we have 140 design engineers who help our customers design their product as a service.
Of the 1190 odd crores order book that you had at the end of November, what is the timeline for the completion of the orders?
Let me just 1190 is hard orders. We have contracts also exceeding that. Okay, so it is half that. So around 12 to 14 months is what we believe is the time frame to execute it.
So how, if you look at your revenue profile, how it's moving, and the kind of client additions that have happened, you have for 210 odd clients which you had. What is the kind of CAGR of growth? Because you ended FY22 at 840 odd crores. So is there a predictability in the kind of growth that you have?
So actually, you can predict it pretty well. Apart from this component supply issues, we do have problems. We have supply chain issues. It's not gone away. It's still there. Some of our, couple of our major, we're still fighting a couple of chips here or there. So it's not a perfect model yet. But 3 years back, you could predict it. Okay, we believe it's coming to that in the next 3 to 6 months. Okay, where the component lead times have shortened and we can predict it. So, so otherwise we will always have this one chip availability. Not only us, the whole industry is facing it, and it's just not Avalon fighting for the components. You have the world majors. I don't want to name them because I cannot, fighting along with us. Okay, and we believe that it's a light at the end of the tunnel is coming. We see the lead times come back to normal in 6 to 9 months.
Just to add it, in terms of
yeah.
revenue growth, we are seeing two sectors. The growth can be bifurcated in two segments. Okay, when the customer comes in for our business model where they are outsourcing the core product, they stay with you. Okay, of course their demand goes up and down in terms of their external demand, but they stay and we grow along with them in the existing products. We are also seeing new products which are moving beyond the because of geopolitics and all of them. So we are seeing two segments of the growth, and the second one is what is much more robust now, which everybody knows about the industry tailwinds, what's happening. Okay, so that part, of course, is a sudden ramp what you're seeing, and the whole industry is getting benefit of that. So if you want to see the total growth, you have to see it in totality, not what is existing, but also what the industry tailwinds and the corresponding growth what you're seeing from.
Mr. Bicha, just to understand, between the time a customer comes in, a new customer comes in, and you start producing for them, is there a lead time which is there normally?
So normally, let's say in cleaner, the industry is a lot shorter. It's 3 to 6 months, so a little bit more with the component lead times. Okay, but in certain industries like rail and air, it's longer. It's around a year plus. In air, a little bit more. But the good thing for us is we are already ensconced in some of the larger organizations. Okay, so we're supplying to a few factories. We're going to the next factory for the next supply. So we're already approved. So the longer lead times sometimes are reduced. Okay, and there's some interesting time. But usually, I would say in a perfect world where we don't have supply chain stories, between 4 months to 6 months, we should be launching the product. But today it's elongated because of supply chain challenges.
Mr. Subramanian, from a cash flow and cash position point of view, you are net positive cash, but that requires frequent equity infusion. Like this year, you had 30 odd crores already infused in your balance sheet. What is the kind of cash generation position? Because you've been also doing a capex. You've already done 21 crores out of capex for the first 8 months. What is the capex program that you have? You have a Chennai facility which you recently bought. What kind of capacity that will it add, and what kind of segmentation it's going to cater to?
Yeah, maybe let me take on the capex part of it first. One of the important point, from a business model perspective, we are a fairly capitalized business. We look at FY22 gross fixed assets about 150 crores, and net is about 110 crores. So we will continue to remain a capitalized business as a business model. We are, unlike some of peers, we are not going to invest a lot of money in terms of land, building, etc. We have acquired recently building of about 150,000 square feet space that should cover ourselves in terms of next 3 years from a land and building. As you know, in India, land and building is a long lead item that we are pretty much covered on that, and we will remain capitalized. In terms of our expectations of based on the current order book, we expect anywhere between 40 to 50 crore per annum capex for the next 3 years. So per annum for 3 years. Okay, that's in terms of what we
40 to 50 crores.
Yeah, are the max. Okay, is the what we are looking at. Okay, so this is including what we have already bought, etc., and the refurbishment of the building, etc. That's in terms of what we do. So we will remain capitalized moving forward, and that should cover the robust order book what you are seeing and the industry tailwinds what we are getting benefit of. That should cover ourselves. Okay, and in terms of the cash flow, what you asked about it. If you're growing at 10 to 15%, we've been a profitable company and growing at 10 to 15%, we can self-fund ourselves, we can continue to fund. The current IPO plan itself is to make sure, if the growth is beyond that and what we are seeing in FY22 is like that. So, and if you're going to see, based on the current, what we are seeing expectations, we want to make sure that growth is fully funded. So anything beyond it will require capital infusion, and that's the reason what we are looking at going to IPO.
Yeah. So between your inventory, which gets normalized in 6 to 9 months or 2 to 3 quarters, and your reduction in short-term debt, which will be around 40 to 50% order, and capital working capital requirement, is there enough headroom for you to increase your EBITDA margins beyond between 12 to 15%?
Our EBITDA margins, today we are operating about 10 to 12% and continue to do that. Okay. And one of the reasons EBITDA, like typically any company which has a capacity utilization about 60 to 65%, if you're able to increase the throughput, okay, you will see the operating leverage coming into play, which should push the margins up for any company. And that should happen to us as well in terms of moving forward.
Mr. Bicha and Mr. Subramanian, it's been a pleasure talking to you today on IPO Adda. The Avalon Technologies IPO opens on April 3rd and closes on April 6th. Price between 415 to 436, fresh issue of 320 and OFS of 545 crores. Thank you very much for joining us on.
Thank you.
Thank
You
you
for
the
having us.
opportunity.